and welcome to the Adjusted for Risk podcast here from the shores of Lake Tahoe. Today's episode is sponsored by award-winning Zephyr, which helps advisors, wealth managers, financial analysts, and investment professionals make more informed investment decisions on behalf of their clients. Since Zephyr's inception some 30 years ago, Zephyr has been recognized as an industry leader in investment analytics. That status has not occurred overnight. It has been built on years of thought-provoking content and research and unparalleled presentation of analytics that help investment professionals tell their story, and the creation of new analytics that help these same investment professionals tell their entire story, not just part of it. So through a series of Zephyr StatFact videos, I will be trying to, or helping you, make sense of some of these investment metrics that are either used today or maybe not used enough in today's marketplace, and how you can use these metrics in your practice. Some of you may be familiar with the Zephyr StatFacts, which was the creation or brainchild of former Zephyr colleague Mark Odo. I'm going to go ahead and take these fantastic resources that have been put together over the years and put them in a video format for you to either listen or watch. There are a lot of great investment metrics out there. And in some cases, it can be like alphabet soup, which can make it very confusing in determining what metric an investment professional should use. So hopefully this series of StatFact podcasts can make it easier for you, and try staying StatFact podcast 10 times fast. It's a good challenge. So I'm going to start with the pain index, which is a Zephyr proprietary risk measure. Like I said, there's a lot of very popular metrics that someone can use to showcase their management, but most of them only tell part of the investment story. Markets have evolved just as the way risk is looked at has evolved. Back in the 50s and 60s and 70s, guys like Markowitz and Sharp looked at risk in terms of volatility and uncertainty. So if a fund's returns were up and down, that was considered volatile, such as standard deviation and variance. So more recently, we've experienced the dot-com bubble, the great financial crisis, issues in Europe, and the pandemic lockdown. Markets have not been kind to investors, and therefore the risk has been more about capital preservation or minimizing loss. Now it's not so much about, did you beat the market? Now it's about, did you lose me money? You can have a good alpha or a good information ratio, but if the market was down, say 50%, and you were down 45%, sure, you beat the market, but you still lost a lot of money. So due to the changing investment landscape, investor psychology, more investors are concerned about capital preservation than just simply beating the market or a specific benchmark. One of the more popular capital preservation metrics that we see used today, and that is referenced today, is maximum drawdown, which simply looks at an investment's maximum peak to trough loss and only tells us one dimension of capital preservation. It does not tell us how long it took to recover from the loss, or if the investment even recovered at all. A maximum drawdown does not tell us if other losses were short and sharp or long and drawn out. So the team at Zephyr has created the next generation of capital preservation statistics, and it all started with the pain index. So the Zephyr's pain index addresses the shortcomings of the maximum drawdown statistic. And it takes it a step further by taking a more comprehensive look at all of a manager or investment's periods of losses, not just its largest loss. So the Zephyr Pain Index quantifies the capital preservation tendencies of a manager or index. It measures the depth, duration, and frequency of periods of loss. So losing money is painful. So the pain index attempts to measure the complete scope of losses, not just the deepest loss, but all periods of loss. So you may ask, what is a good number for the pain index? So there is no hard and fast rule or breakpoint that separates a good pain index from a bad pain index. One must really compare a manager's pain index against an appropriate benchmark or a peer group in order to gain an understanding of whether a manager's pain index is good or bad. It can be said that the lower the pain number, the better. Because intuitively, the investor would prefer smaller overall losses, shorter periods of loss, and infrequent losses. So all three of those would translate to a smaller pain index. Pain index of 0 would represent the best possible outcome, meaning the investment never lost value. For example, there are two very important elements one should keep in mind, namely the asset class under consideration and the time frame. Now, risky asset classes like emerging market equities have exhibited periods of significant losses. Conversely, investment-grade bonds, on the other hand, have historically experienced very little pain until recently with the current bear market for fixed income. But the other key contextual element is the time frame. In the 1980s and 90s, losses were few and far between. In the 2000s, losses were much more common. You had the dot-com bubble. You had the great financial crisis. And I don't have to mention the big losses we have experienced in the 2020s due in large part to the pandemic lockdown. So what are the limitations? The pain index completely ignores the upside. So an investment with a very high pain index is signaling a lot of losses might also have a large number of gains too. So the pain index ignores that large number of gains and just strictly focuses on the losses. Okay, so those gains are not captured by the pain index. Now, this may not matter to some. For example, myself, when I think about risk and capital preservation, my primary concern or primary risk is losing money, not so much just volatility or variance in a return stream. Or I don't really consider upside or the good volatility risk or bad risk. I am more worried about, has my investment lost money? But like I said, that mindset ignores a large portion of this story. And for some, that matters. So, when looking at capital preservation statistics, Zephyr highly recommends that you take a look at the pain index. Pain index takes a more comprehensive look at capital preservation tendencies of a manager or an investment. And you shouldn't just focus on one maximum drawdown, rather than focus more on the entire story. Take an entire story or approach or view of your manager or investments, all their drawdowns, all their periods of losses, to capture that entire story of your manager's capital preservation tendencies. So with that being said, that ends today's Zephyr StatFact edition of Adjusted for Risk. I will also be posting additional resources regarding the Zephyr Pain Index on the Wealth of Insight from 6,237 feet. So with that, thank you very much for listening and watching, and I hope you all have a great rest of your week. Thank you.